What's good, everybody? It's your boy Sham, the BJJ Lender. Today, we're talking about one of the most misunderstood and most powerful tax strategies available to high-income earners, solar. And let me be clear right out the gate. This is not about putting panels on your house. This is not about saving the planet, vibes only. This is about using solar as a federally incentivized asset to redirect money you were already going to send to the IRS into ownership, credits, and long-term tax strategy. This is a sweep, not a scramble. Hit my damn intro. All right, y'all, before we jump into today's episode, I want to rewind for a second because this is part 3 of what I call the trifecta. In episode 6, we talked about charitable giving. That's the backbone. Charitable strategies are about eliminating AGI. You're intentionally redirecting dollars that were already going to the IRS into causes, impact, and long-term planning. Clean, structured, purpose-driven. Then, in episode 7, we broke down oil and gas. That's a multi-generational strategy. Oil and gas works through operational deductions, drilling costs, ongoing expenses, and paper losses, which can offset income while still generating passive cash flow. More aggressive, more nuanced, not for everyone. Now, here's the key. Maybe charitable giving makes sense for you, but oil and gas doesn't. Maybe you don't like fossil fuels. Maybe you don't want that level of operational exposure. Or maybe you're looking for an alternative energy option that still creates meaningful tax savings. That's where solar comes in. For some of you, solar is the alternative. For others, it's the complement. And for a smaller group, those with real capital and real tax exposure, it becomes part of a stacked strategy. Charitable giving reduces AGI. Oil and gas creates paper losses. Solar uses credits and depreciation to attack what's left. Now, and this part matters, these strategies, y'all, are not for everyone. They depend on income, liquidity, timing, and risk tolerance. This content is for educational purposes only. I'm not your CPA. I'm not your attorney. I'm just a guy on YouTube breaking down how the tax code works. So always talk to qualified professionals before making decisions. Now that we've got that recap out of the way, let's jump into today's topic, solar. Solar didn't become a tax strategy because of influences. It became a tax strategy because the federal government needed private capital to build energy infrastructure. For decades, renewable energy incentives were used almost exclusively by large banks, insurance companies, and Fortune 500 corporations to reduce their effective tax rates. What's changed recently is access. Certain structures now allow private clients to participate in those same incentives. Using the same sections of the tax code institutions have relied on for years. Let's talk about that in jiu-jitsu terms. A sweep works because your opponent's weight is already committed. With solar, your tax liability already exists. We're just redirecting the momentum. This is where a lot of people get confused. This is not a fund. This is not a security. This is not a pay it back later deferral. At its core, properly structured solar strategies involve ownership of qualifying assets through an entity, typically an LLC. That distinction matters because certain clean energy assets receive favorable treatment under the tax code when they're owned, operated, and documented correctly. That's the difference between holding top position and just stalling for points. Solar works because it gives you two engines. First, tax credits. Credits reduce your tax bill dollar for dollar. Second, accelerated depreciation. Depreciation reduces the taxable income that creates the tax bill in the first place. Credit attacks the liability. Depreciation attacks the income. Same play, 2 layers. That's a sweep straight into the mount. No reset, you advance position. Like I said, solar isn't for everyone. This typically fits high-income W-2 earners with large tax exposures, entrepreneurs with strong cash flow, investors with liquidity events, people whose biggest expense is taxes. If cash flow is tight, this probably ain't your first move. But if taxes are consistently your largest line item, solar becomes a real conversation. This is where strategy matters. Charitable giving is often the foundation. Reducing AGI first. Solar, depreciation, and other asset strategies optimize what's left. Some clients run 1 play, some run 2, some can run all 3. You don't force a sequence, you build it based on income, liquidity, and goals. You don't jump to the finish without control. So solar is powerful, but only when it's done clean. Here's some red flags: no clear ownership, no insurance or warranties, no CPA or legal coordination, overpromising outcomes, poor documentation. This is infrastructure investing. This is not a TikTok hack. A sloppy sweep gets you past. Clean mechanics keep you safe. At Fortitude Strategic Wealth, solar is never pitched in isolation. We review income. We coordinate with tax professionals. We model outcomes conservatively. We document everything and we sequence properly. No hype, no guessing, no gambling. Plus, that's haram anyway, bro. We don't gamble here. We Muslim. Halal, baby. If you're earning $300,000 or more and taxes feel like your biggest opponent, and it should be, solar can be one of the cleanest ways to redirect that pressure if it fits your plan. Hit the link, book the consult. We'll tell you straight whether this makes sense for you or not. Like, follow, subscribe on YouTube, IG, and TikTok at the BJJ Lender. Drop a comment, share this with someone who needs it, and stay locked in. Because you already know, out here, we don't just roll, we strategize. Until next time, it's your boy Sham. Follow me at the BJJ Lender. See you next week.